everyone. Myself Shreya DL, studying in first year MCom, Department of PG Studies in Commerce, Government First Grade College of Arts, Science and Commerce Shira. Subject is Advanced Financial Management. Topic is Private Equity Investment Strategy, taught by Tirumala M, Coordinator of Department of PG Studies in Commerce. We discuss about the private equity investment, private equity strategies. First, we discuss about the history of the private equity investment. The founder of the private equity is J.P. Morgan. In 1901, J.P. Morgan bought Carnegie Steel Corporation for rupees 480 million and merged it with Federal Steel Company and National Tube to create U.S. Steel in one of the earliest corporate buyouts and one of the largest relative to the size of the market and the economic. Next one, in 1919, Henry Ford used mostly borrowed money to buy out his partners who had sued when he slashed dividends to build a new auto plant. In 1989, KKR engineered what is still the largest leveraged buyout in history after adjusting for inflation by buying RJR Nabisco for rupees 25 billion. This is the history of the private equity investment. Introduction to private equity. Private equity can add value to investor portfolios in two main ways. First, by giving access to investment opportunity that are simply not available in public markets. As companies stay private for longer, much of the value that was previously generated in public markets is now being built under the private ownership. Next, the private equity role. It operates with investments or investor and users fund to invest in private company or buy out public company. The terms of the private equity investment is usually last from 3 to 5 years, means the period or terms of the private equity investment is 3 to 5 years. Next, the investors to bring capital from institutional investors to invest in companies. This is the introduction to private equity. Next, we move towards the meaning of private equity. Private equity refers to investment made in companies that are not publicly traded. Most private equity firms are open to accredited investors or high net worth individuals, and successful private equity managers can earn over $1 million a year. This means the capital investment made in companies. The private equity invest in company not a publicly traded and high network of individuals, and they earn the managers the individuals earn $1 million a year. This is the meaning of private equity. Next we discuss about the introduction to private equity investment. Private equity investment describe investment partnership that buy and manage companies before selling them. Private equity firm operate this investment fund and behalf of institutional and accredited investors. This is the introduction to private equity investment. This means the investment of partnership to buy and manage the company before selling them, before selling the private equity, and the operate investment fund behalf of institutional and institutional investors and accredited investors. This is the introduction to private equity investment. Next we discuss about the meaning of private equity investment. A private equity investment is a pool of investors who make direct investment in private enterprises. This share equity capital is not traded on the stock market India and is often used to invest in a variety of sector or to follow industry specific criteria. This means the pool of the investors who make direct invest in private enterprises. The investors is directly made the investment in private enterprises or personal enterprises. The share equity capital is added on the not added on the stock market. This share is not added to the stock market in India and invest in various sector. The private equity investment is a investment in variety of sectors or various sectors or follow the investment specific criteria. This is the meaning of the private equity investment. Next we discuss about the private equity strategies. What are the strategies to help or to make investment in private equity? First we discuss about the venture capital. Providing equity startup capital for early stage venture, usually in a particular industry sector or geographic region. Venture capital providing equity to startup companies or startup business to help start the new business in market. This was very important help for private equity investment in the venture capital. Next, growth equity. Private equity is providing equity capital for later stage venture who are looking to scale up their market or operation. Growth equity. It growth in capital for later stage venture. This is the later stage venture who looking after scale their market or operations. Next one, buyouts. Focusing on acquiring majority stakes in established public companies in order to take them private and restructuring them. This buyout is divided into two types: leverage buyout and management buyout. Next one, private credit. Providing senior loan to private companies who need working capital. This one is providing loans and company to make her need working capital or doing working capital. Next we discuss about the fifth one, distressed debt. Loans and borrowings to company experience financial or operational distress, default and bankruptcy. Next one, impact. Investment that are managed with the goal of generating not only a financial return but also the positive social and environmental impact. This private equity investment is not effect on the only the financial return or financially related matters that but also positive effect on social and environmental impact also. Next, infrastructure. Supplying capital for large scale projects generally considered to represent public infrastructure. The supplying capital are large scale project to make or provide many infrastructure to generate public infrastructures or supplying the large scale project or investments in the private equity. Next one, last one, secondaries. Specializing in acquiring shorter term private equity asset from other fund to provide liquidity or asset with a arranging exist. Secondary is providing liquidity or easily converting into cash. Asset with arranging exits. The secondary is help for a private equity investment in companies. These slides shows the firms are active in the India. Many firms are companies. They have private equities investments. Next, conclusion. The future of private equity strategy firm at the assets level, particularly in infrastructure, are more likely than others to be sustainable in the large or long term because return, fees and compensation are already lower and they were perceiving as doing some social good. These are all the private equity investment strategies, and conclusion are the private equities investment.